Have you ever wondered how to earn money while you sleep? Imagine a world where your money is working for you around the clock, generating income even as you rest. That world exists, and it's called passive income. It's a concept that allows you to break free from the traditional 9-to-5 grind, transforming your financial future. Today we're going to explore two powerful strategies for building passive income: dividend investing and peer-to-peer lending. Dividend investing is all about buying shares in companies that regularly pay out a portion of their profits to shareholders. On the other hand, peer-to-peer lending involves lending money to individuals or small businesses through online platforms, earning interest as they repay their loans. Both strategies have their advantages and potential challenges, but when executed correctly, they can provide a steady stream of income with little to no effort on your part. So buckle up and stay tuned to learn how to generate a stream of income with little to no effort. Let's dive into our first strategy: dividend investing. So, what is dividend investing? In simple words, it's an investing strategy that revolves around buying shares of companies that regularly pay out dividends. Dividends are portions of a company's earnings that are distributed to shareholders as a token of appreciation. Now, you may be asking, how does this work? Well, think of it like this. You're essentially becoming part owner of a company when you buy its shares. As an owner, you're entitled to a slice of the company's profits, which are your dividends. Companies usually pay out dividends on a quarterly, semi-annual, or annual basis. So, where should you consider investing? Some of the top industries for dividend investing include utilities, consumer goods, and pharmaceuticals. These sectors are often characterized by stable, mature companies that generate consistent profits. Because these companies aren't likely to reinvest all their earnings back into the business, they have the capacity to pay out steady dividends to their shareholders. But what's in it for you? The major benefit of dividend investing is the potential for passive income. Imagine sitting back, relaxing, and watching as dividends roll into your account. It's a great way to supplement your income and can be particularly beneficial for those planning for retirement. Moreover, dividend investing can offer some degree of protection during market downturns. While stock prices may fluctuate, companies with a history of paying dividends are likely to continue doing so, providing a steady income stream. But remember, no investment is without risk. Dividend investing does come with its own set of challenges. Companies can and do cut dividends, and stock prices can fall. Therefore, it's crucial to diversify your portfolio and not rely solely on dividends for your returns. Now that you have a basic understanding of dividend investing, let's discuss how to get started. Getting started with dividend investing is simpler than you might think. First off, it's essential to understand what you're looking for. You want to find companies or exchange-traded funds, ETFs, that not only pay dividends but also have a history of steady dividend growth. This means they consistently increase their dividend payments over time. Now, where do you find these golden geese? You can start by using online financial platforms. Look for tools that allow you to filter stocks or ETFs by their dividend yield, which is the annual dividend payment divided by the stock's price. You'll want to consider those with a high dividend yield, but don't stop there. It's also crucial to dig a bit deeper into the company's financials. Ensure that the company has a solid track record of profitability and a low debt-to-equity ratio. This ensures the company can afford to keep paying and hopefully increasing those dividends. Once you've selected your dividend stocks or ETFs, the next step is to buy and hold. That's right, patience is key here. Dividend investing is a long-term strategy, and here comes the real magic: reinvesting dividends. Instead of taking those dividends as cash, reinvest them to buy more shares. This leads to compound growth, where your dividends earn more dividends. With these steps, you're well on your way to becoming a dividend investor. Now let's explore our second strategy: peer-to-peer lending. Peer-to-peer or P2P lending is a form of direct lending of money to individuals or businesses without the need for a financial institution to act as an intermediary. This is typically done through online platforms that connect borrowers and lenders. Imagine a digital marketplace where you could lend money directly to someone who needs it, and in return you get paid back with interest. It's like being a one-person bank, but without the need for a massive vault or a fancy suit. That's essentially what P2P lending is all about. These platforms have sprouted up all over the internet, each offering their unique spin on the P2P lending model. Some of the top sites include Lending Club, Prosper, and Upstart. These platforms allow you to diversify your investments across multiple loans, reducing the risk of any single loan defaulting. Now you may be wondering, what's in it for you? Well, the potential returns for P2P investors can be quite attractive. Since you're cutting out the middleman, the interest rates can be higher than what you'd get from a traditional savings account or even some dividend stocks. It's not uncommon to see average returns in the range of 5 to 7%. Of course, like any investment, there's no guarantee of returns, but diversification and careful selection of borrowers can help mitigate some of the risks. In fact, some platforms even provide credit scores and risk ratings for potential borrowers, helping you make more informed decisions. But it's not just about the returns. P2P lending also offers you the opportunity to make a direct impact. You could be helping someone consolidate their debt, start a business, or even finance their dream wedding. While P2P lending can be lucrative, it's important to understand the risks involved. Just like any other investment, it's crucial to do your research, understand the platform, and make sure it aligns with your financial goals and risk tolerance. Remember, investing is not a sprint, but a marathon. It's all about making steady strides towards your financial goals. As with any investment, P2P lending comes with its own set of risks. Firstly, there's the credit risk. When you lend money to peers, there's always the chance they might not pay you back. This is why it's crucial to diversify your investments over a broad range of borrowers. If one borrower defaults, it won't wipe out your entire investment. Then there's a platform risk. P2P lending platforms act as intermediaries between lenders and borrowers. If the platform goes bankrupt, it could be challenging to recover your money. Thus, it's essential to choose reliable, well-established platforms with good track records. Interest rate risk is another factor. If interest rates in the broader market rise, the fixed interest rates on your P2P loans may not look as attractive, and your money might have been better invested elsewhere. Now let's consider mitigation. Diversification, as mentioned earlier, is key. Spreading your investments across many borrowers can help cushion the blow if one or more of them defaults. Furthermore, researching borrowers' creditworthiness can help you make informed decisions. Case studies show that while some investors have lost money in P2P lending, others have made substantial profits. It's not a guaranteed path to riches, but with careful planning and risk mitigation, it can be a profitable component of a diversified investment portfolio. By understanding these risks, you can make informed decisions and increase your chances of success. So, you've learned about dividend investing and P2P lending. But should you stick to one strategy or combine them? This is a question many investors grapple with. On one hand, focusing on a single strategy allows you to become an expert, honing your skills and knowledge in that specific area. For instance, if you choose dividend investing, you might spend your time studying industries that historically pay high dividends, such as utilities and real estate investment trusts. Over time, you can build a portfolio of dividend-paying stocks or ETFs that align with your financial goals. On the other hand, diversification, the practice of spreading your investments across different assets or asset classes, is a fundamental principle of investing. By combining dividend investing with P2P lending, you can diversify your sources of passive income. This can potentially reduce your overall risk. If one strategy underperforms, the other might offset the losses. However, diversification is not without its challenges. Each investment strategy requires a unique set of skills and knowledge. For instance, to succeed in P2P lending, you need to understand the platform's underwriting criteria, evaluate borrower profiles, and manage loan defaults. It's a different ballgame compared to dividend investing. Moreover, each investment strategy has its own legal and regulatory considerations. For dividend investing, you need to understand tax implications of dividend income. For P2P lending, it's crucial to know the platform's regulatory compliance, such as borrowers' rights and data privacy. Remember, there's no one-size-fits-all approach to investing. Some investors might find success focusing on one strategy, while others might thrive with a diversified portfolio. It all depends on your risk tolerance, time commitment, and financial goals. In conclusion, combining dividend investing and P2P lending can offer potential benefits of diversification, but it also requires a broader skill set and understanding of different legal and regulatory environments. Whether you choose to focus on one strategy or diversify, remember, to always do your research and consider your financial goals. Making informed decisions is the key to successful investing.